Michael Burry. We all know who he actually is, even if we don't necessarily know him by name. Well, you probably would recognize Christian Bale's performance as Michael Burry in the film The Big Short. He is an insanely successful investor and has consistently beaten the S&P 500's returns ever since he started his first fund back during the peak of the dot-com bubble. He garnered much fanfare when he successfully predicted and then bet against the housing market crash of 2006 and made himself hundreds of millions of dollars in the process. Now, and really ever since the COVID boom really took off, Burry has been pointing out the insane valuations in the markets, and he's been calling it out as a rightful bubble. Now, 10 months into 2022, and stocks everywhere are falling week by week and month by month. The S&P 500 is currently down by over 20%, and at its worst, it's been down by 25%. The Nasdaq, on the other hand, has had an even harder time of it, where its losses have fallen by 35%. It's plain and simple to see the market crash is here to anyone who's brave enough to open their eyes and see it. But Michael Burry has recently come out with some ominous tweets revealing his belief that actually, no, things aren't done and they're going to get so much worse. Now, the first thing that Burry rallied against was the tech bubble that we've recently seen, and in particular, he's rallied against the ridiculous valuations of a bunch of companies that are plain and simple in no position to create profits anytime soon, and yet still there are investors willing to keep their money in these failing corporations. This morning, there were still 218 primary stock listings in the United States with a market cap of over $1 billion and EBITDA less than negative $100 million. 29 of them had market caps of $10 billion or more, totaling $655 billion. Saying it again, all the silliness must go. Now, Burry is very specifically pointing out the fact that despite these drawdowns in the markets over 2022 so far, even if they do feel really quite tough and really quite strong, valuations of a lot of companies are still way off base, with 29 companies in particular representing $655 billion in market value, and yet not a single one of those companies can create even $1 in profit over an entire year, and in fact, they all lose hundreds of millions of dollars every year. And this is, let's not forget, only publicly traded companies that Burry is actually talking about this here. There are hundreds of other companies just like this and more in places like Silicon Valley with insane private market valuations yet no profits, and actually, again, they lose millions constantly. This is silliness, as Burry just said, and until it is done for, until these occurrences are rare and outliers instead of being commonplace, the markets are going to continue to fall, and that plain and simple is what Burry said with this tweet. Now, a couple days after that first tweet, Burry then tweeted this. The difference between now and 2000 is the passive investing bubble that inflated steadily over the last decades. All theatres are overcrowded, and the only way anyone can get out is by trampling each other, and still the door is only so big. Here, Burry rallies against the passive investing index bubble that he's spoken about before, and he points out that it is still actually present as well, again to the delusion of many people. As index funds and brokerage apps have become so common and so easy to use over recent years, trillions of dollars have flowed into the markets from ordinary people who don't really know how to invest, and so they pick passive investments, which is usually a good thing. The problem is, though, because all of these investments are passive, none of this has resulted in any real price discovery. When you buy an S&P 500 index fund, you buy parts of the biggest companies like Apple, Microsoft, and Google simply because they are parts of the biggest businesses. You don't actually take a look at the fundamentals of Google and why you might like to own that stock. You buy them because they're big. And when this happens en masse, when you see millions of people doing this with trillions of colluded dollars, then you see these companies continue to inflate further because they simply put are the biggest. Burry's saying that the theatres are crowded with investors, and when the rout truly starts, or if something worse happens and there's something like a fire, when people start running for the doors, most people will not make it out and most people will lose their investments. Then Burry tweeted more evidence that actually the market crash is not yet over and that it's going to keep on coming for some more time. 13.48% of stocks closed above their 200-day moving average yesterday. Bottom in 2009 was 1.2%, bottom in 2020 was 2.8%. Currently, we're at December 2007 levels. Burry here is pointing out that there are still many stocks that are actually performing okay on the grand scheme of things, even though the markets on the whole are down and by a decent proportion. Historically though, when you look at major market crashes, almost all stocks fall a very large amount and for a sustained period as well. Burry is specifically looking at the 200-day moving average of these companies to see if they are still falling or if they're maybe maintaining their value or if they're even continuing to inflate. And by that metric, we are far, far from the end. December 2007 was barely halfway through the global financial crisis, and Burry seems to think that we are probably somewhere similar in regards to that with the 2022 market crash that we're in right now. What then is the most recent thing that Michael Burry has said about the markets? Well, he simply tweeted this. This was coming because it has always been this way before. How anyone over the age of 40 did not see it coming is a riddle, the answer being greed. He posted alongside that a slightly cryptic graph which isn't clear what it is at first. It doesn't have any scales, any axes, or any labelings indicating to what it is actually showing, but it seems to mirror almost identically Cathie Wood's ARK K portfolio over the last 2 years, and that was clearly in a bubble. Burry's message here is very simple. It was so damn obvious to anyone willing to actually look at the facts. People like Cathie Wood, who never saw this crash coming, had blinded themselves by greed. They'd convinced themselves that this time it was different, that this technology was so revolutionary that there would never be a market crash again, and that this bubble would never pop, but they were of course wrong. They wanted it to continue, so they believed that it would continue, and Burry is specifically naming and shaming Cathie Wood here, just in a way that only those who actually pay attention and can recognize this graph are able to see. And frankly, he's right to do so. She has lost her investors billions of dollars this year, and she's refused to admit any kind of wrongdoing as she does so, getting prediction after prediction wrong month after month. Why she still seems to have some kind of a positive name in some areas of the internet will forever bewilder me, but that's where we are. But Michael Burry's ideas about the market right now should be quite clear. The market crash is already here, we are right in the middle of it, and sadly it isn't even nearly over yet. The question on everyone's mind though is he right about that? And my honest answer here is that yes, he probably is. Burry's opinions on the markets are not like normal investors or YouTubers or someone like myself. They're not at all based on feelings or loose ideas of what the Fed is going to do or anything like that. They're based on data, on cold hard facts, and the data is soundly in support of Michael Burry. We have seen bubbles like this one before, to different extents, yes, but bubbles are bubbles, and by looking back at those previous occurrences, we can see how extreme the drawdowns were, and while it may feel like the world is ending today, like stocks literally can't get any lower, it was so much worse in these previous market crashes, so it stands to reason that actually it's probably going to get worse here again. As always, the critique against Burry is this whole he's predicted 17 of the last 3 market crashes, or this example here, Burry has predicted 30 of the last 2 market crashes, implying that he's actually wrong more than he's right, but those who say this really don't actually understand what market crashes are or how they look. This idea is basically that crashes are instant, that stocks go up for years on end, then on a single day in 2008 or in a single day during the dot-com bubble, every stock everywhere fell by 90% and then the markets just kept on going back up again. As a result of this weird idea, there are those that claim that we aren't even in a market crash today still after drawdowns of 20 to 30% over the course of 10 whole months because it hasn't been instant, as if that has ever been a requirement of a market crash. I think this is likely due to 2 different things. The first, that most investors and most people watching YouTube videos who I interact with are relatively new investors, and also people and their memories are quite frankly crap. Most of the people parroting this idea are only looking back to the 2020 market crash, which was a once-in-a-lifetime crash as it was caused by the government's reaction to a virus and not for usual cyclical recessionary things. These lockdowns happened instantly and overnight, and under those circumstances, yes, the crash was instant, but for every other market crash in the history of mankind, that has not been the case. No one in their right mind would claim that the dot-com bubble didn't end in a massive market crash, and no one in their right mind would argue that the 2008 financial crisis didn't end in a massive market crash, but people are still sitting here today and saying that Burry was wrong because there hasn't been this one singular day where stocks fall by 70% across the board. This graph behind me right here shows the S&P 500 during the 2008 financial crisis in yellow and the S&P 500 over the last couple of years in white. As you can see, the markets are behaving in an almost identical way today as they were back in 2008, and yet people have this weird idea that the '08 market crash happened instantly and that the only days the markets actually fell were when Lehman Brothers fell and where Bear Stearns collapsed, but that simply isn't the case. The 2008 financial crash saw stocks fall week after week and month after month for almost 2 entire years, from June 2007 to March 2008. The dot-com crash saw stocks consistently fall from August 2000 to February 2003, which was even longer than 2 entire years. Burry hasn't been predicting 10 different crashes throughout 2022, he's been predicting one crash on many separate occasions and reiterating that claim time after time. That is going to last for months or even years, but people are simply too stupid to even look at a chart and see what a crash actually looks like to think that this invalidates all of his claims. The simple truth is we are in the middle of this market crash, and so far it has lasted for just over 10 months, and in comparison to some other recent market crashes, that means it's barely even halfway done. So if you see anyone posting a funny quip about Burry predicting more crashes than he's actually been successful, politely remind them to actually watch the entire length of this video, and in particular this part here where I explained why those people are so wrong. As Burry likes to say, I might be early, but I'm not wrong. So until next time, stay stoic.